What's currently like hot in your head as a strategy vice president? Like, what are you thinking of in the next 2, 3, 5 years? What will you be releasing? Share as much as you can.
Yeah.
Sure.
I think there's a lot of this data platform continues to be a big need in the market. And I think if you go to most of the big conglomerates at the moment, the big sort of, technology providers in the sector, and if you go to their sort of strategy annual reports, I think there's like two terms that always jump in continuously. It's data and AI.
Now, like, what's the right product to invest in or to create?
Yeah, so that's right. We're quite deep into R&D. So just to give you a bit of a sense, our R&D expenses, I think for last year was something around 800 to 900 million. So almost like 15% of our net sales. So, and I think we released only like 400 to 450 products, of which about 60% of those is just like pure innovation, like new products. And about 40% are different like upgrades or part of like the product life cycle and so on and so forth. And yeah, how we balance of like, where do we put our chips in where we want to grow. And I mean, there's a couple different dimensions here that we look at. I would say the first one is we're always in touch with our customers to understand how they use our products, what type of workflows they integrate our products in. And we see across those workflows, what's the use of the products that we provide.
What's your advice to the founders who are negotiating acquisition with companies like Hexagon?
Yeah, what's the advice? Number one, remember I discussed this topic of like 1 + 1 = 3. So I think for founders, it's very good also to understand how Hexagon can accelerate their sales, right? How it can accelerate their technology roadmap. And, Hexagon looks at a product, looks at a solution, looks at a company and thinks of how can I leverage that company's go-to-market channel or technology to grow the rest of my product line. I think it's very, very important for founders, not just the Hexagon, but when they look at a strategic acquirer, to understand how can they create also more value for that acquirer across their products, and also then how can they leverage it for their own specific products growth.
Hey everyone, and welcome to the Bricks and Bytes podcast, where we dive into construction and AEC technology. Before we get started though, if you're a startup founder or operator responsible for innovation in your company, or you want a deeper, more insightful look into technology in AEC, you won't want to miss our newsletter. From deep dives into particular technologies such as AI, robotics, design, software, and so on. Hot takes from investors betting big in AEC technology, and advice on building tech companies, including the stories and takeaways of the most successful AEC technology founders. Head over to www.bricks-bytes.com and sign up today to get this exclusive material straight to your inbox. And now for the episode.
This episode is brought to you by Build Vision, transforming construction supply chain by bringing contractors, manufacturers, and stakeholders onto a single software platform. Visit buildvision.io to find out.
Good afternoon, guys. Alex, thank you for joining us. So Alex, we're going to dive a little bit today about Hexagon, and then more specifically to that, the mergers and acquisitions within Hexagon and perhaps a wider AEC landscape if we get there. And yeah, just see how you guys, I think we were just discussing, Hexagon is like, was it a 6 billion turnover company?
Yeah.
Which is
2 billion-ish valuation.
It's 2 billion-ish. So quite a significant player in the field. And like just to be open, I guess, about our discussion before we went live, we were saying before you reached out, we had certainly had not heard of Hexagon before, which is kind of strange because we're quite deeply ingrained in the ecosystem. So with that said, I think it would be good if you could tell us a little bit, Alex, about what Hexagon is and its significance in the AEC space.
Yeah. No, in the spirit of transparency, what we're discussing, I also didn't know much about Hexagon, right, until maybe in the last couple of years when they started integrating a lot of their brands and be a bit more, more invested in marketing and trying to get the Hexagon brand out there. But yeah, so who is Hexagon as a company and what they do, right? So at Hexagon, we provide technology and services that basically captures the real world. So when we say real world, everything from survey points, digital layout, photos, videos, point clouds, and reality capture, and so on and so forth. And then once we capture all these field data, all these site data, we basically activate it for customers under different forms. We can activate it as an as-built 3D model. We can activate it in terms of our construction insights, right, on how you're doing progress, how you're doing quality. We can bring these 3D models into sort of facility management, asset management platforms, right, where people want to move away from just sort of workflows on a computer screen, and they want to become a bit more AR, VR in terms of learning how to navigate their facilities and so on and so forth. So that's the essence of what we do. We capture the real world. We create as-built digital twins, so digital twin instances, and we activate all this data for all sorts of workflows, all sorts of use cases. And as we said, in terms of size, around $6 billion in revenue, so all of Hexagon. I would say roughly about between a third and a half of that is focused on the construction infrastructure sort of sectors. And the rest is focused on manufacturing, energy, so other sectors as well. And
it's hardware and software, right? So hardware through capturing and then software through the enablement of the digital
so we have about 3 layers. The first layer, which is one that we're quite known for because we have a brand that people are very familiar with, which is Leica, which is survey reality capture equipment, digital layout out of Switzerland. That's sort of like the hardware piece. But of course, there's also some software that goes with like making that operational. Then the second piece is something like pure software digital products. And these are software solutions like, Bricks, for example. It's a CAD company. We have companies like, for example, ProjectMate is a company.
Bricks CAD is yours as well.
Yeah. Bricks is for Hexagon as well.
Oh. That was who we spoke to, Conic, Mark from Conic. I think he used to work for Brix's high up exit there. So cool. So see, now the picture is starting to be painted, right? We see who Hexagon is.
Well, I didn't know about Hexagon, but I've been using Hexagon, Leica, since I went to uni, and we were surveying some stuff with the theodolite, or I don't know what's the word in English, and measuring stuff with your equipment. Yeah. And so it's a hardware and software company, right?
Yeah, that's correct.
Okay. Browsing through the website, I can see there's 836 items in the product search. How do you figure out like what's the right product to invest in or to create?
Yeah, so that's right. We we're quite deep into R&D. So just to give you a bit of a sense, our R&D expenses, I think for last year was something around 800 to 900 million. So almost like 15% of our net sales. So, and I think we released only like 400 to 450 products, of which about 60% of those is just like pure innovation, new products. About 40% are different like upgrades or part of sort of like the product life cycle, so on and so forth. And
hey listeners, I want to take a quick break to remind you about the Bricks and Bytes newsletter. If you're interested in learning about the technology shaping the future of construction, you won't want to miss the valuable insights we share each week. To get this exclusive content delivered straight to your inbox, head over to www.bricks-bytes.com and sign up today. Link is in the show notes. Back to the show.
Yeah, how we balance of like, where do we put our chips, where we want to grow. And I mean, there's a couple of different dimensions here that we look at. I would say the first one is we're always in touch with our customers to understand how they use our products, what type of workflows they integrate our products in. And we see across those workflows, what's the use of the products that we provide. So for example, let's say a lot of our hardware was very much used just for, capturing survey points, right? But today, a lot of our hardware is used also in BIM coordination, digital layout, because now you can go on site, you can actually get a pretty accurate point cloud of what you built, and now you can import that back into the BIM model, and your site teams can coordinate the model throughout construction, right, as part of their VDC teams. So we're always looking like what are the products which are adjacent to our products, where we would like to expand either organically or to M&A. The second dimension that we look at is, of course, what are the different segments which are growing the fastest, right? So for example, if you look at, you can look at the CAT, the CAT, right? It's a very big market, but the growth has been maybe slightly less than a lot of the AI point solutions. Or if you look at the market which sort of covers reality capture market has been growing very fast. So again, then we're always trying to invest into the areas which are growing faster, because we always take a lens of, okay, what's the products we release next year, but also like where do we want to be in like 5 to 10 years, because we need to have that long-term look when you're this size. It's good because most likely you're going to be around 10 years from now. So you need to solve for long-term problems as well. And the third part where we invest is when we talk to our customers and we understand their vision of what they want to do. And if we look around the market and we don't see products which address that need, then we decide, okay, let's see if we have a base of customers that's large enough that we know this is going to be more like a global problem, then we decide to invest in it. This was the case, for example, of our digital reality platform, right? 3 years ago, and even today, some customers are saying, look, like I have all these site data that I'm collecting, right, on a daily basis, especially now that, reality capture has, taken off. Now I can fly in drones quite cheaply on my project, and I'm collecting terabytes and terabytes of data, but I still sometimes have to travel with the hard drive from the field to the office, upload it, and so on and so forth. It would be so nice to just have a platform where I can upload all my photos, videos, point clouds, right, integrated seamlessly into one model. And that's when we realized, okay, we need a platform for the market. It connects very nicely our hardware and software. So therefore, we're going to invest. This is how our digital reality platform was born. And I think it was announced about 2 years ago. And from then, it just kept growing.
Mm-hmm. What's currently like hot in your head as a strategy vice president? Like, what are you thinking of in the next 2, 3, 5 years? What you will be releasing? Share as much as you can.
So I think there's a lot of this data platform continues to be a big need in the market. And I think if you go to most of the big conglomerates at the moment, the big sort of, technology providers in the sector, and if you go to their sort of strategy annual reports, I think there's like 2 terms that always jump in you, continuously. It's data and AI. I mean, almost every single report, those are the 2 terms that always, and they do pop up for a reason, right? Because AI leverages data. And if you want to be a data collector and a data enabler for customers, then you need to have some type of platform. So, what's going to be hot for us is going to be to continue to expand this platform. The second thing that's very important is, again, there's no surprise, more and more in the field and also during design development, visual reviews, 3D reviews, AR, VR is becoming more and more predominant, right? If you sit in a room, if a contractor and an architect sit down with an owner to review how a project's going to look like in the pre-construction stage, very few review 2D drawings at the moment. I mean, of course, smaller the projects, they review 2D drawings, but if they're bigger projects, you start to have sort of, you pull it up on the screen and start to navigate to the 3D model for the customer to get a sense of the spatial. So again, because we do capture digital reality, we do a lot of scans, we do a lot of modeling. For us, being able to bring this VR angle to the field is very important. The third one that's very important is construction insights, especially enabled by a lot of the sort of the AI engines. And here is, I think probably the most famous use cases are in progress at the moment, right? You can go on site, you can scan the site on a weekly basis, and you get certain insights, and you can tell you, okay, where you are in the construction progress, compared to the week before. Also where you are compared to the original sort of 3D model that you develop in design, because you can compare the two. Now, the reality is that we do have the technology today to do that, right? And there's a lot of startups and scale-ups in the market who do that. That's going to continue to grow, but that today is provided by services as almost like a bridge until the technology is going to be simple and self-sufficient enough to be managed only by a GC or only by an architect, or only by a specialty contractor. And then lastly, also this 3D visualization angle seems to become more and more predominant in facility management for a lot of the owner facility teams, like all the technicians on site, because there is a struggle, right? We always talk about there's not enough labor to be able to support with the need in the construction industry. Well, that's also the case in facility management, where universities and hospitals and big portfolio managers cannot hire technicians fast enough to maintain their facilities. So how do you make them more productive is, instead for a facility manager to get a work order that says, hey, in room XYZ 2.3 on floor whatever in this building, there could be an issue with the pump, and he's going to waste 2 hours to walk up and down the building trying to find that pump. Instead, he can actually look at the most optimized path of where the pump is in the model before it even gets to site, right? So now you're able to manage multiple assets with like one technician in a much more productive way. So if I'm to summarize a little bit, is number one, the big one is the digital reality data play. I think there's no clear winner in this space at the moment, and the customer need continues to grow. And because we see a lot of excitement there, that's where we're going to continue to double down on. And then the second part is all these point solutions around 3D visualization for both planning, construction, as well as facility management, and construction insights. I think is going to become more predominant.
Interesting, Alex. What is how does this strategy get executed then? I think, based on my understanding of Hexagon, is they're quite heavy on the mergers and acquisition strategy. Could you explain to our audience?
If I could add to this question also, just very briefly. So you said 800-900 million a year you spend on R&D. I guess the acquisitions are not included in this.
No.
So there is a separate acquisition budget, I guess.
Yes, I mean, I wouldn't say there's a budget per se. But typically, if there's an opportunity that we like a lot, and of course that we run, business model and so on and so forth, then we decide to go for it or not. And I guess just for the audience, right? Because also this kind of ties into the question of like, who is Hexagon? And one of the reasons why people in the construction, in the AECO space don't know about the Hexagon brand that well is because we are a company that's grown over the last 25 years. I think we've done something like almost like over 160 acquisitions, right? So quite a lot. I mean, of course, they range in size, right? They range from very, very big companies, like Bricks Bytes, for example, and they range to also like smaller companies. But I mean, the question is like, how do we execute on the strategy? We always have two levers. The first lever is R&D, and the second lever is M&A. Typically, we look at R&D where we see that we have the capability in-house to develop something like a very strong product. Also, R&D is the answer where there's not a lot of companies in the market or products in the market who provide to the level that we think they should provide in terms of quality. Thirdly, we also look at R&D where we do have a product that with a bit of tweaking or a bit of added features and so on and so forth can be tweaked to address that particular use case. Because a lot of our customers, they don't ask us for technology, they ask us for use cases. So, I want to be able to understand the quality if my column was built in the right place, or if, it was built 2 inches to the right or 2 inches to the left, right? And we have various ways in which we can provide that value to a customer. So that's where we go with R&D.
So maybe just to add an example, Alex, like maybe you would consider R&D. You mentioned the 4 points earlier. So let's just pick digital data and AI. You may look to R&D to try and find solutions that would help to service that. I don't know what you call it, but area.
Exactly, because when it comes to data management, we already have a very strong solution in the market. So what we need to do is continue to improve that and to continue to improve that with customers on the use cases that they use them. Also in the regions where our customers are, because, the other challenge is that you can build a data platform, but then you need data centers to be able to run in specific regions. A lot of countries have specific data protocols. You cannot bring data from one country to another one, right? So yes, that was like just going to be an internal R&D play. And then AI, it depends is the question. If it's an AI use case, again, that hasn't been quite used in the market, building some of the AI engines is not that difficult if you have the data to train it, right? Or if you can create easily the synthetic data to train it. But it also kind of matters a little bit on, is there a product that has had a lot of sort of adoption by the market? So, as we all know in construction, you can have the greatest tech, but some companies have failed on the greatest tech because they were not shrewd enough on the go-to-market, right? They were not shrewd enough of making their tech so easily understood by the customer, by the contractor in the field, because contractors are like, field superintendents are like no BS people. You make my life easy, or I don't have time to waste with PhDs sort of walking me through exciting tech. So either you save me time or you didn't, and I'm probably going to give you all of like 2 seconds to prove it. So sometimes it happens that the tech is not so difficult, but because there's a startup or a scale-up out there which has established itself in the market so well, that then we use M&A to basically buy customer access, to buy a position in the market, and to buy a great product that, a great product is also great technology that has been marketed really well.
Mm-hmm. I just wanted to put some things into some perspective. So earlier today, we had a chat with Patrick Hellerman about his report about funding in our space for Q4 last year. And so between 2023 and 24, so within a year, the AEC Tech raised around $3.2 billion, in funding.
You have good memory.
No, I'm just looking at the screen. So, and in 900 million in Q4. Okay. So with your R&D strategy to spend around 900 million a year, you basically have like 30% of the purchasing power of the whole, like a 1 year
investment.
Landscape. In our space, which is absolutely crazy and mind blowing when I think about it.
Yes, and this is just Hexagon. All the other strategic players.
I was going to ask you about
the specialty ones like Autodesk, Bentley, Procore, and the non-specialty ones who spend quite a lot now in technologies, like I take the Googles and the Oracles and stuff like that. So it becomes but at the same time, I also see huge benefits into startups, right? When they create a new product, because they have a lot more agility and a lot more focus into deploying their product to a specific use case, right? So when a large company develops a product, and if we need to invest millions of dollars in it, we would likely look at what are all the different use cases that we can use that product over time, right? What are all the different sectors we can bring that product, right? You can start with something in construction to solve 4 or 5 use cases. Then you can also bring it to mining. You can also bring it to city planning and mobile mapping and stuff like that, right? So there's a lot of different use cases that we can use. I would say startups have the luxury of they can develop one product that's simple for one use case and just go very deep with that one use case, right? And whereas some of the bigger companies, of course, there's teams that we can try to do that with, but we always keep an eye on what's the bigger sort of opportunity here. And that sometimes makes products maybe not so basic enough to be deployed, although we try to pride ourselves on that our products are quite simple, like simple to use.
Yeah. So Alex, could you could we maybe dive into then the M&A strategy and like how it all starts? So you may be considering like one of these 4 areas again, and you say, oh look, there's an interesting startup that we might look to initiate a conversation about an acquisition, whatever it might be. Could you maybe talk us through look how you go about maybe sourcing a company that might be suitable for a to be acquired, and then like what is the process from there on?
Yeah, so I would say that, so first of all, there's around M&A, there's sort of like a proactive way to do it, and there's a reactive way to do it. And the proactive and the reactive, the way I define it, and these are not sort of industry terms. This is a non-finance person like me trying to sort of, make sense of the M&A world. The proactive way of doing it is we actually scan the market, and we always keep a database of all the company, most of the companies that are interesting to us out there. What are the workflows they cover? What we think is their estimated revenue based on employees, based on customers that we know that are being served and so on and so forth. So we always keep a database of companies. We also, what we do is we reach out to all of these companies and we try to partner with them. And we partner with them because through a partnership, what you can achieve is a more extended workflow than you can achieve with your own solutions. The problem with the construction market is, as you guys know and everyone knows, is that there's no site in this world where you're going to go and you're going to find only Hexagon products. From the design software to the reality capture software, like you might use someone else's drones, you might use your data platform, but you might use Procore. So it's always a mush of different solutions. So then what we do is we look at, okay, what are the interesting companies which extend our workflow, that we can tie our technology already. They operate in markets that are interesting for us, customers that are interesting for us, building types which are interesting for us. And then we partner with, we create a pilot. And if those pilots are successful, then we could think about, okay, would it make more sense for this company to be part of a Hexagon portfolio than just an external partner that we did a pilot and we have a workflow with. And I'll go deeper into that, like how then, we take the process from there on. The second part in which we do M&A is sort of like the reactive part. Here, you're in constant touch with the investment community, and the investment community can be VCs that you're always in touch with, because there's always some type of an exit plan, right? And a lot of the exit plans sort of aim towards IPOs, but a lot of them just to develop solutions which could be acquired by strategic investor at one point. And there it's VCs and private equity firms that we're in touch with. The VCs mostly cover sort of startups and scale-ups, right? So sort of more innovative technologies, more innovative use cases. Whereas private equity firms, we see them more focused on scale-ups sort of beyond maturity, right?
Mm-hmm.
Or you could have a 25-year-old software that actually is doing very well, has a huge customer base, basically owns a market or can be expanded globally. And then, if it was part of a private equity firm, the likelihood is that the company was, this is probably not the right term, but it was like cleaned up and made more efficient, right? And maybe integrated with another company that they bought. So then you're buying even a bigger workflow. And every now and then they actually ping us and they're like, hey guys, I think we are within a 6 to 12-month window of potentially divesting in this company. Are you guys interested? So that's more like an opportunistic sort of reactive way for us to always be in touch with companies which are available for purchase. There's not always a ratio that I can say, we do 50% or 50%, because it depends on the year, right? Sometimes we have a lot of companies which come our way from, private equity firms and VCs, and we just don't find them interesting enough. And sometimes, there's one big acquisition and that already covers 90% then of the M&A that we do for that year.
Yeah. Are you looking at specific metrics for a company? Is it very like particular to perhaps the technology that you're looking at, or are there like some parameters that are like, no, they all have to meet this?
No. I mean, we look at, so first of all, so the first thing that we look at is actually how good is the product? Of course, the revenue matters, EBIT matters, and so on and so forth. But the product and how the customers with the product for us is the most. If you don't have a good product, forget the revenue, right? Like, I mean, either it's had a good run, but you don't quite know how it's going to end up in the next 5 years. And when you acquire a company, you want it to have a pretty good run, right? A 5-year plan, a 10-year plan, because it's going to be yours for quite a while. So we always look at product metrics. Product metrics is, you can infer it from a variety of, like, retention rate for customers, churn rate, how many customers are leaving your product or not renewing, because that gives an indication the customers like it or not. Then, of course, we look at the technology. So we actually have, lots of people within Hexagon we can always deploy, and they can take a look at the code, and they can take a look at the actual tech, and they can give you a diagnostic of, this is pretty cool, this is pretty basic, or is it to integrate or not easy to integrate. And the third thing that we look at is, indeed, the financials. So as a company, I would say that we have some metrics that we look at. We would like it to be of a sufficiently big size. I mean, some, $10 million revenue. That's probably something that will be very interesting for us. It's not a law. It's not like we only look at companies over 10 million.
Yeah.
You also look at companies who, they make a lot less than that. They're probably 4 PhD students from some university who started a year ago, but the tech is so amazing that it would unlock a world of new use cases for the other solutions that we have, right? Typically, you want it to be quite sizable. And the fourth metric that we look at a company, and actually this is way more important than I think a lot of people realize, is sort of the people and the culture of the company. You go into a startup, and even from the moment you walk in, you kind of realize in the early days of sort of having meetings and doing pilots and so on and so forth, you very quickly realize like how energetic people are about the product, and like how excited they are to be there versus, people who are just there to just make a product and make an exit one day, and then you're kind of like, oh, okay, this kind of feels all transactional. Right. And
you want everyone jumping around the office doing high fives and cartwheels and stuff, yeah.
Yeah, exactly. Happy hours and all that, right? But yeah, I would say like those are the 4 things that we look at. Like some are metrics, like hardcore metrics. Some are just diagnostics on technology. And some are just maybe some more subjective observations on like the culture and the attitude of people. And, because I mean, that matters, right? It's almost like when you go on a, first date, like, is the chemistry there or not? That actually matters a lot, because those people eventually are going to have to work with other people within Hexagon.
I'm actually curious, based on what you say, my feeling is that you not only acquire tech startups, but also more traditional businesses.
Yes. That's very true. So actually, that's a very important thing to mention. Yes, we acquired technology providers, but we also acquire service businesses. We also acquire distribution partners. And it kind of depends on the type of product. So there's a lot of distribution partners out there, resellers of hardware, right, in certain geographies, which they're a very good business. They make very good money, right? They have
What's the PEs of those? Like if you know, what is the PE of those, like good cash flowing businesses?
What does PE mean?
Price to earnings, like the ratio?
Oh, I couldn't answer that.
Okay, that's fine.
I couldn't, yeah. But I know we're involved with at least 2 of those at the moment. And
this is purely for cash flows, or they have
No, also, so one of, not purely cash flow. I mean, it has to be a good business, right? But there's also other dimensions to it. If it's a market that we think is going to grow a lot, like take some of the markets in Southeast Asia, for example, take some of the markets in Latin America, then we could look at, having access to the market also with feet on the ground. Because the thing about distributors, resellers is they're very close to customers, right? So if we really want to get, you can get a report. You can buy a report for $5,000. Hey, what do competitors in Vietnam think about XYZ? Or you can actually talk to those people, right?
Yeah.
And also you can talk to those people at an upper management level. So, it's one thing for me to talk to the CEO of a Southeast Asian construction company and I get a certain perspective. And it's also a more detailed perspective that you get when the distributor talks to their, field engineers and surveyors and project managers on site, right? So it's always good to get as much input as possible and to have these type of boots on the ground. The second, also the reason why, having these type of businesses it's important is sometimes what happens, and this is true for most of the technology providers, is if you go through other indirect channels rather than your direct workforce, you don't always know who your customer is. So, I think there's some big technology like software providers, I cannot name from the US, but as big as us, who over the last 2 years, they've started a process of registering users, right? Because they were selling software through resellers and they had no idea who the end customer was, right? They had an idea that, it's located in this country and, based on how many licenses that they buy, could be a medium-sized company, but they didn't know there was XYZ company. They couldn't even get in touch with them. They couldn't understand what do they use their software for. How do they use their software in combination with other software solutions, right? So they have no visibility, right? Because, of course, resellers and distributors, they wouldn't want to sort of lose, it's like traders, having this type of like insight is part of like how they basically create their place in the market. But of course, when those reseller distributors become part of your business, you have access to understand more who those customers are, to basically improve their workflows and improve your position in that market. So yeah, distributors, resellers, and also service providers. So when I say service providers, is we bought we acquired a company, which we were very fortunate for the founders to join us. It's called Voyancy. And this is, I'm oversimplifying right now, but this is sort of like BIM VDC services. So this is a company that's like 350 people strong, and they actually go on construction sites, either for owners or general contractors, and they basically staff the BIM and the VDC team. They do the model coordination for them. They do the reality capture on site for them, right? And again, these are very well-performing service businesses. And the good thing about having a service business combined with your technology is you basically get closer to the customer and start using your technology before the technology is simple or mature enough, or the customer has been educated enough to use it by themselves. So, let's take the reality capture to progress insights and quality insights workflow. Some of the bigger GCs in North America can probably do it because they have their own internal BIM and VDC teams, although I would argue that even on not all of their projects, right? They probably pick and choose the ones which are highest risk, or the ones where also the owners are incentivized to use technology for, various use cases. But the average sort of mid-market GC in North America, on your average project, when you build a school or something, people just build it the old way. 2D drawings, you have a team of like 3 superintendents on site, and that's kind of it, right? So being able to approach those customers, do the modeling for them, do the reality capture for them, and improve their lives, and make their teams more productive, more efficient, and have more visibility into where the risks are on schedule or something. It's a very good way for you to start to deploy your technology. And eventually, hopefully, you get to a point where in 3-4 years, by the time the customers have been educated enough on the technology, is not something new anymore. It becomes kind of a common thing on construction sites. Then at least your technology is the first one and those customers were used to 3 years ago when it was provided as a service. Whereas I think the bigger mistake is to develop only technology and wait many years until that technology is like 99% accurate, because the reality is by then you're already like to market, not first.
So you
So
you need to sell the outcome rather than just like a technology and hope that it all adds up together.
And Martin, that's another good point that you're making, is what we see at customers is they're also getting a bit more educated on how to pay for a lot of these services or the tech. So if we look at most of the technology provided pricing models, traditionally, it's always been like a license, or you just outright buy the hardware, right? Whereas now we see certain customers moving to outcome as a service. So, percentage of volume of construction. So now you can go to a customer and you can say like, okay, you can buy my, hardware for X amount of dollars, or I can provide you a service and you pay me based on how the risk profile of the job changes, right? So people are becoming a bit more educated, more creative in how to pay for technology and or services together with that.
Yeah.
Cool. Alex, would Hexagon ever acquire one of the big players like OpenSpace? That just comes to mind as the first company.
Thought you're going to ask about Bricks and Bytes.
Well, we'll get to that one when we stop recording, of course.
So I can't say yes or no, right? We have acquired big companies before, so
that would be like a viable exit strategy, sorry to interrupt, for someone like OpenSpace would be to sell to a player like Hexagon, right? Let's just ignore OpenSpace as a name, but just like another reality capture tech provider.
Rumors.
Yeah, so I'm not totally familiar with, the OpenSpace business plan, but companies like that, right? They have two decisions to make. Do I have a big enough market remaining where I can expand to the point where an IPO is going to make sense, right? Or do I have the right customer captured with a product that makes sense to be part of the workflow of another strategic partner or, technology provider? I mean, if I was founding my own company and I would be not a startup anymore, but a scale up at that point, to me, that's how I've been looking at things. So here's what I would say is, from our point of view as a big strategic technology provider and an investor, is when you are that size, first of all, we need to understand the financials very, very well. Because when you're early into your journey, you can afford to burn a lot of cash, have no margin, right? Because you want to grow really fast. Either you want to be first to market, or but if you are already a scale up that already makes tens of millions of dollars in revenue, you are establishing the market. A strategic investor we would probably look at, do you have an EBIT right now that's positive, or are you on a realistic path to have a positive EBIT in the foreseeable future? So that's how I would look at that. The second thing that I would do is I would have to make sure that your customers love your product enough that are going to continue to love it for the next 5 years, and you're going to continue to expand the product in the next 5 years. And the third one, when you buy a company that size, you're probably going to pay quite a bit of money for it, right? And in that case, a company like us will be looking at, can I make 1 + 1 = 3? So, okay, I get this product from this company. It creates 50 million in revenue. I have hardware that creates, I don't know, for just the numbers, makes 100 million revenue for this product. The two combined in a workflow cannot make 150. They have to make 250.
Yeah.
Because suddenly I can cross sell between the different customers, the products, right? I'm sure there's probably customers who would use, again, OpenSpace is just a placeholder right now, but there's probably customers who use OpenSpace who don't use Hexagon technologies and vice versa. So that has to be the case. And then number two, there has to be a workflow that connects the two. For it to make sense. So again, the answer is not no. It really depends, and I think financials start to become a lot more important for these size companies than startup that just has cool tech.
Yeah, makes sense.
So, how many did you say you acquired in total? 119?
No, I think it's like the number I have in my head is like 162 since 2002. But
since 2002.
Since 2002, 162 companies. Yeah. So, but I'm not 100% sure on those companies, but it's somewhere in the 160 to 200 range over the course of about 25 years, plus minus. So quite a lot. And I mean, there were some, small acquisitions, companies which are 4 people, and there were some big acquisitions like,
What was the smallest, the biggest, if you can share, if you remember?
I mean, the smallest is probably hard to say because there's been quite a few which were just small, right? Yeah. I think we acquired I can't give the name, but we acquired a Finnish technology provider which provides sort of spatial anchoring technology, and there were not, I think there were like 6 people, if I'm not mistaken. However, the technology was super valuable, right, in other applications. And some of the bigger ones, I mean, I think they were well over $1 billion, right? And they were, so they were quite big. And this was at a time also where, $1 billion acquisitions in the space wasn't like, I feel like right now, today, every other company is worth $1 billion on paper. These are companies a couple of years ago who were actually financially, you could do the math and they would be not just on paper, but also in terms of value creation and all that.
Yeah. So what's exciting though, when I look at this, like you acquire like 5, 6, 7 companies a year, statistically, just looking at the maths here. So
it's quite, Alex, and on that, is there like does Hexagon have is a word like agenda maybe, whereby you have to acquire 5 companies per year because of X, a bit like say venture capital have to deploy their capital because of the
They will tell you they don't have to.
No, you'll be surprised actually. So we do have that in the plan. So I think if you look at, even if you look at the 2023 annual report, I believe, right? In the 2023 annual report, I think you said something along the lines of like, we are shooting for, I think it was like 10% or so, or 8% growth, of which 4% organic, 3% inorganic, so M&A. So we do have targets to grow by anywhere between 3 and 5% per year, our revenue through M&A. So this is an established strategy that it's worked very well for us for 25 years, and it's continuing to be a very, very significant lever for us.
I got a question about how do you see M&A market like right now and perhaps moving forward? But as I was listening to you, I don't know how much this question makes sense, because you have a great cash flowing business. So it's not that you are getting some investors' money to acquire companies, or you don't operate on leverage, I guess, when you're buying these, right? It's all from the balance sheet, from your own balance sheet, right? So I guess it's evergreen for you. The market for mergers and acquisitions, right?
Yes, I think is the short answer. And I mean, how do we see the market? Patrick's done a great presentation, right, on how he's seen quarter AEC investments go. What I would say a bit subjectively right now, because I don't have the data in front of me, is if I look back at 2024. If I look at back at the type of companies that we're interested in, right? Like companies who are of a certain size in the AECO space, they also make a buck in profit at the end of the day. There were a lot of companies which were willing to be acquired last year, right? So I think there were I cannot disclose the names of the companies which even came on the market, but I would say compared to 2023, there were less that came over, on our desk. From what we're, in discussions with investors and stuff like that, it seems that 2025 is going to take a little like a turn again in the upswing. I think there's going to be a lot more activity. Again, I can't speak a lot to the activity in terms of like VC investments, right? But when it comes to sizable companies, at least from what it seems at the moment, is that Q3, Q4 might be quite active in terms of sizable companies in the ACO space who want to make a certain exit, their investors, and these are companies that, again, I mean, they're scale ups. They make good profit at the end of the day, so they're quite established players.
So I would just have one more question or last question on the M&A. So when you are in talks to acquire or not a company, but acquire a company, is there like a bidding market? Is there a competition, like a market making between you perhaps and some other company that you are bidding, or how is it structured?
Yeah.
Okay.
So I would say, remember when I said that there's this sort of like the proactive way, and then the inactive sort of opportunistic way where you get presented with something that is on the market to be bought. So most likely,
okay. Normally, in like typical terms, if you're reacting, you're too late, huh?
Not necessarily too late. I'm not an investor, but there's also, I put myself right now in the shoes of an investor, right? I would probably believe that if I have an asset right now, and I'm being approached by a strategic investor to buy it early, I might also get less return on it. Less, the acquisition price might be low, right? Whereas if I put it on the market, it's not a car, right? But like if we go through the normal acquisition process, and the company is a good company, right? It's got to be a good product. It's got to have high customer retention. It's got to make good EBIT, and it's got to have a really good 5-year growth plan, because that determines the multiple, right? If you can show that you're going to grow your revenue by 20-30% every year, I mean, the multiple that you're going to get on that type of company is probably going to be quite significant. So if you can show all those, if you're an investor and you or a founder, and you truly believe you have a good company, it's probably going to be quite good for you to take it through a typical acquisition process where you actually create competition between the different acquirers, right? So but for the acquirer, for us, if we're in that process, yes, it could be that we're late at the party, not really late at the party, but probably if it was a good asset and we could have, we could have probably also approached it earlier. But I mean, you never really know with these things. You kind of have to take them as they come. But and sorry, Martin, your question was around.
So is there like a competition being created by the founder, really, like that? So is the founder like looking for different buyers and then let them bid in a competitive way, or there's like conversation only with you and you kind of trying to negotiate with founder to exclude others? Like, how does it look like?
Yeah, I think we also spoke to someone recently who had a significant exit, and they mentioned that I suppose similar to taking investment, right? They didn't always take the best deal. They went for the company that felt like the best fit, not monetarily, but in other ways.
Yes, that's so. Number one, to answer, there is competition, especially when it's an acquisition process, because all these, like the companies actually hire a banking entity to basically run the process as an independent banking entity. So there is competition. In the other bucket, which is more like proactive from our end, it's probably less competition, but it does happen that, a founder doesn't want to sell the company, but we convince them that, look, an acquisition is probably not a bad idea. You can grow faster, maybe even you can have additional capital and so on and so forth. But then the founder also thinks like, okay, well, if I have decided to sell, then let me see also, if I can get other interested parties in, right?
What's the market saying?
And then through either the VC investor or the private equity, then you could create competition just by basically approaching a company. I would say that doesn't happen that often. Typically, when we proactively approach a company, we we approach a company because, I wanted the process. First, we create a pilot with them. We go to customers jointly. We create a workflow for customers. So typically that happens because our products with their products, our sales team with their sales team, our R&D team with their R&D team have already worked together quite closely, and they like each other, and we both believe there's joint value there. So typically at that point, just becomes a conversation between what's the fair price, or sometimes not even about the acquisition price. It's more about, okay, once we become part of the Hexagon family, how are we going to operate as a brand or as a product, right? And to answer your second question, the thing that you mentioned is some of the founders don't even take the highest price. Yes, that sometimes happens, because if you look at some of the big strategic investors, they acquire companies, and within 3 years, the brand disappears.
Yeah.
They're folded in, they become a technology, half of their team gets laid off, right? So this happens quite often. So then if you're a founder, you have to make a decision. Is like, okay, have I created a cool technology at this point, or a great product? Then, c'est la vie. I'm going to work for that company for about 1 or 2 years, and then, that's it. I start the next project. Or I think this product truly has many, many years left to grow. And I really think that the workflows, like with us at Hexagon, for example, really make sense. And we can really penetrate new markets, because also Hexagon is global, right? Whereas a lot of these scale-up companies, they're regional, maybe national at best, right? And through us, they can go global. And, sometimes we have an advantage there, because if you look at most of the brands that we acquired, a lot of them have stayed untouched. They have a part of Hexagon underneath their logo, but they still have the same CEOs for a very long time. So Multivista, same CEO as was the founder. Oxblue, same CEO as the founder. So it's Voyancy, same CEO as the founder. So we, founders find it that within Hexagon, it's actually quite you grow up quite nicely, right? And you're able to leverage also our R&D resources and so on and so forth. So yeah.
Very good.
Interesting.
Really, my last question within this subject is, what's the
You
advice?
said that before.
I know, but I said really the last
Now you're
one.
taking the piss.
Exactly. What's your advice to the founders who are negotiating acquisition with companies like Hexagon?
Yeah. What's the advice? Number one, remember I discussed this topic of 1 + 1 = 3.
Mhm.
So I think for founders, it's very good also to understand how Hexagon can accelerate their sales, right? How it can accelerate their technology roadmap. And, Hexagon looks at a product, looks at a solution, looks at a company, and thinks of how can I leverage that company's go-to-market channel or technology to grow the rest of my product line. I think it's very, very important for founders, not just the Hexagon, but when they look at a strategic acquirer, to understand how can they create also more value for that acquirer across their products, and also then how can they leverage it for their own specific products. So if I was a founder who had an AI solution in Northeast US serving general contractors, what I would approach Hexagon would be these two lenses. First of all, how can I help Hexagon sell more of their solutions where I already have a footprint? To either the current GCs, what type of workflows I can bring. But also I will look the other way around. Is, okay, Hexagon has distribution partners, there's a footprint in all of North America, all of Europe, Southeast Asia, Australia, right? How can I leverage Hexagon to also grow my product? And I think that sometimes doesn't, of course, at the end of the due diligence process, you kind of come up with those initiatives because you have to, right? It's part of the business plan of acquiring someone. But in the very initial phases of the interaction, that it's almost, they focus too much on explaining how great their product is. It's almost like they're trying to sell their product, and not so much focusing on how can we jointly create value for each other if we do get married.
So focus on the bigger picture rather than on your love to yourself.
Yeah. you have to love yourself, right, to create a great product. But yeah, it's more
Yeah.
this sort of like this 1 + 1 = 3. How can we make that happen for both of us?
Very good.
Rather than look how great my product is, look how great my people are, look how much our customers love us, right? It's like we already know that at that point if we've approached that conversation.
Fair enough. Maybe a couple more before we run out of time. But Alex, what does your day-to-day look like? Are you lots of traveling, meeting founders? Are you more involved at a company level? Like maybe you could just talk to that.
Yeah. So, I mean, first of all, my role, right? And probably should have started this at the very
Yeah,
beginning.
we always start with that, but we got so ingrained in Hexagon.
Yeah. So my role is Vice President of Strategy and Execution for the AECO space, right? But basically what that translates is how do I help Hexagon grow in the AECO space? That's basically sort of the summary of it. And growth happens, first of all, with our own businesses and products, right? Because if we take some of the companies we've acquired, they still have their own strategy team and they still have their own marketing team. They still have their own sales team. So they already have a pretty good idea of how they want to grow, right? But a lot of that growth happens at the adjacency of the product, incremental growth. But what I'm focusing on a little bit is what some of the transformational growth that we can have as a company, right? Is there a completely new segment that we're not active in that we should go into? Is there a technology that we don't have within our portfolio that really could glue two sort of separate pieces together in a workflow that customers actually pay real money for, right? So then if given that that's my responsibility, and also if we do come with an initiative, some initiatives, we co-develop with the business and the products, and then they are taking over that. But sometimes if there's an initiative that doesn't have a natural own in the current product portfolio, then I would probably take it to the extent where it's mature enough to be taken by someone else, right? So, and therefore, because, given that that's my responsibility, we have a market research team, business intelligence teams that always looks at, maintaining this list of scale ups and always keeping an eye on also what's our competition doing. Then we do a lot of analysis on like business models, right? Because innovation doesn't come just from products. Innovation comes also from like a pricing strategy, for example. Innovation also comes from being able that you're organized in the right way and you have the right internal capabilities to deliver on your growth strategy. So it comes from a lot of different segments. But I would say mostly what I do on my daily basis is, number one, I'm always in touch with customers, or I'm always in touch with like big companies in the space, real estate developers, construction companies, always trying to understand from them two perspectives. Number one, what technology are they excited about? Because that gives me an understanding of like, what are they really comfortable with, right? But the second part is always understanding what pain points that they have to the point where, it makes sense for us to come with a workflow that helps them. The second thing that I do is, of course, always be informed on all sorts of market analytics, right? And, and then the third one that I do is always try to keep myself updated on all the great innovation that we're doing internally. Because as I said, we have 430 new products released only in the last 12 months. Right, I need to be educated on a daily basis. What's the product we released today? So it's
that's more than one a day.
Just having a full understanding on a company this size, what's all the innovation that we develop is that in itself. It's quite an effort.
So I've got my last and probably more general question. What are your hacks and tricks when it comes to creating successful strategy and execution?
Yes. So I would say two, and this assumes that I'm creating a successful strategy, right? Because probably someone else would judge me on that.
Maybe it will be us.
But I would say two. First of all, whatever your growth initiatives are, make sure you've tested it multiple times with customers across all the different levels of customers. I'll tell you some examples, right? Sometimes I have a conversation with the CEO or an SVP from a construction company, and they have the 36,000-foot view of how the technology is being deployed, but they might not actually have experience deploying that technology. So they might tell you like, oh yeah, we love reality capture, and we collect our data and we run analysis and we save 20% on time, right? From him, I understand that reality capture is important, but then always talk to the people sort of 3, 4, 5 levels down, the people who actually use the technology, because they could tell you more insights, such as like, yes, this is important, but we're still having problems with deploying this technology in multiple geographies, right? Because the platform is only supporting 3 countries, and we really have a need in this country, right? So it's always having a very detailed understanding of what customers want. The biggest, I think, mistake of developing a strategy is based on products that you think they're needed in the market without testing enough with customers. I think that's the first trick. So that's why I'm always in touch with customers, and that a lot of my travel is around just meeting customers nonstop. And then the second part is, when you develop a strategy, people sometimes make the mistake to focus on only one of the 4 key pillars of the strategy, which, for me is, first of all, you need the mission and what you want to do as a company. But then the 4 pillars are your product portfolio strategy. So what products you're building for which customers to create what value. The second one is the commercial pillar, which is, okay, how are you going to sell those products indirectly or directly through distributors? What's your pricing strategy in which regions? The third pillar is R&D and M&A. Okay, if you have gaps, how do you plan to fill those gaps in our M&A or R&D? And there's a couple questions there. And then the fourth one is, what's your organizational structure and capabilities that's required to deliver on the strategy? And almost every single time when we think about a new initiative, we try to think about what across all of those 4. Oh, it's a new product that we want to develop for, I don't know, the manufacturing industry, for building management in Southeast Asia. Well, we have to understand, okay, are those manufacturers in Southeast Asia actually requiring that product? How are they going to use it? Can it be tied with other products? How are we going to sell it? Do we have the people to sell it in Southeast Asia, or do we have the distribution network to do it? How much we're going to get for that product? Is our R&D team capable enough to build it, or is it going to be faster just by someone, who already provides that solution? And then number 4, are we organized good enough both at, corporate commercial team as well as in the Southeast Asia team in order to deliver it, right? And actually sell it and be able to support customers after they up. So again, I see a lot of, and especially, so I also come from a management consulting background. I was at McKinsey for a couple of years. And even there, I saw people who develop a strategy based on only one of those 4 pillars. Salespeople are very much, I want to develop my commercial strategy without really sort of looking left and right. Product people love to develop products on what they think is right without actually, understanding they can sell them as an organization. I think those are some of the biggest pitfalls that I see companies fall under, not looking across all those 4 pillars simultaneously for every single initiative that they try to create.
Beautiful.
Okay, awesome. Thanks, Alex. Could you tell people where they could find out more about you? And if you want to plug something, maybe some companies you're looking for. I don't know if you can go that public, but go for it.
Yeah, I probably can do that. But yeah, so people can find me on LinkedIn. I think that's probably the easiest. Just type in Alex Brihac Hexagon, I think, on Google, and I think I'm the only one in the world. It's I'm one of those lucky guys that my last name is not very common. So
Yeah. Very good. Cool.
Thank you very
Thanks,
much,
Alex.
Alex.
very good. Thanks, guys. This was fun.